Certainly see an incredible opportunity with Ecora on the value side. The opportunity to acquire exposure in a royalty company for less than the estimated value of the producing asset base and receive, as a result, all the development stage assets as upside is, in my mind, a great entry point and offers a great margin of safety as well.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We're here at the 2025 Rule Symposium in Boca Raton, and I am here with Mark Lefleche of Ecora Resources. Mark, thank you for coming on the show.
Great to be here.
Yes, sir. Pleasure's all on this side of the table. Let's start out with your elevator pitch and market cap, cash, and debt of Ecora Resources.
So Ecora Resources, listed on the London Stock Exchange with the ticker ECOR, listed on the TSX, ticker ECOR, and also trading on the OTCQX platform, ticker ECRAF. Market cap $220 million in US dollars. Net debt, so net of cash and debt, is as our last date approximately $126 million. And revenue last year the business generated approximately $64 million US dollars. A dividend last year. Ecora has a long track record of dividend payments. Last year, distributions equate to, on a last 12-month basis, roughly 3 to 4% yield.
Okay, awesome. And give us an overview of Ecora. You guys are in a transition phase right now of being a royalty company that was primarily focused on coal, and now you're kind of moving into the electric battery metals camp.
Yeah. Well, I'll keep it short, but I can spend a lot of time on this one.
Mm-hmm.
Ecora was blessed with an amazing royalty, and that royalty is called Kestrel.
Okay.
This royalty is in Australia over a parcel of land, and in that land is metallurgical coal. This royalty has generated substantial cash flow, and we have redeployed those cash flows into other royalties as we prepared for mining operations to move out of the Kestrel royalty, focusing on acquiring royalties that are in production or to replace income profile, but also to add growth in addition to that income profile. We have redeployed those cash flows from steel-making coal, which generally in the market trades somewhere in the mid-single digits, into critical minerals, particularly copper. When you look at the royalty sector, those sorts of commodities typically trade in the sort of mid-teens.
Okay. And what, tell us about you and your team and the experience that you guys have that relates to what you're doing at Ecora.
Yeah, the Ecora team is, as far as critical minerals go, we have within the wider company something like plus 70 years of experience structuring royalties, negotiating royalties, evaluating royalties. Our commodity remit is fairly broad. As you can imagine, we're tracking nickel, cobalt, uranium, vanadium, titanium, manganese, rare earths, and more.
Yeah.
So we have a big universe, but that's also really part of the opportunity. I think when we look at the wider commodity complex, there's certainly no shortage of good quality opportunities, and we have the ability to move laterally between commodities as and when commodities are attractive on a cyclical price level basis. The companies run lean like any royalty company, and as I'm sure all your viewers and you'll be very familiar with, having spoken with other royalty companies in the past, the royalty model does not necessarily require a sizable team. Ecora Resources is 11 employees, and on that basis, we have the capability to evaluate, but also manage a much larger royalty portfolio without sizably growing the headcount in the company.
Okay. So you can grow from here and still keep 11 employees.
Yeah. And that's really the beauty of the royalty model. It's very scalable.
Yeah.
Right? I mean, a lot of the work we do is to evaluate royalties up front. And then, of course, we monitor them. But once we own them, the monitoring is far less work relative to actually running a mine.
Yeah.
Of course, as you can imagine, developing a project.
Yeah. I'm putting myself on the spot here with math in public, but I think Franco-Nevada's valuation is something like 40 billion, and they have like 40 employees. So the market cap of each employee is essentially $1 billion.
Yeah, which is incredible.
Yeah.
It's incredible.
I don't know another business that you could do that. Anyways, okay. So you have nickel, cobalt, you've got coal, uranium, copper, vanadium. Um, Tell us about ballpark. You know, nobody's going to hold you to this, but right now and into the you know close future, what percentage of your revenue is coming from each of those commodities that you're getting royalties on now?
Yeah. So if you went back in time to 2020, what you'd see is our base metals royalty portfolio and our specialty minerals generated somewhere between $5 to $10 million.
Hmm.
Again, on research analyst forecasts this year, our base metals royalty portfolio and critical minerals portfolio, more widely inclusive of uranium and vanadium, is expected to generate in the order of 25 to 30 million, which is quite the milestone. Because on that basis, it is forecast to be the first year in the history of Ecora, which where more than half of our revenue is generated from non-coal sources. And then as you look 5 years into the future, the vast majority of the revenue is forecast to be generated from copper, but also supplemented from the other commodities you mentioned as well. So copper is really at the core of our portfolio, but we also have exposure to much wider critical mineral suites. And of course, we're always looking at
Yeah.
new opportunities, new commodities, to further diversify the exposure of the underlying commodity basket. But having now taken the exposure in this portfolio from 0% copper to 50% copper, while we're not necessarily married to the 50% number per se, we are looking to keep copper at the core of our commodity exposure.
Okay, so copper's making up the base of it. About what percentage of your income do you think comes from copper?
This year, we're probably on track for copper revenues to be something like 1/6 of the total revenues.
Okay.
I mean, it's all subject to commodity prices.
I get that. Let's say it's flat. We'll just keep it easy.
Yeah.
No one's asking you to see the future. I just want to get a ballpark idea of
Yeah.
what the commodity breakup is.
Yeah, and then if you move forward to 2030, inclusive of development projects that are expected to be online at the time, copper would be expected to be something like 50 to 60, 70% of total revenue. But again, it's subject to the timing of when projects are brought online, but
Yeah.
also commodity prices at the time as well.
Yeah, yeah. And about what percentage of your income is coming from cobalt?
This year, it's expected to be, again, subject to commodity prices and volumes, something in the order of 25% of the total revenue this year.
Okay, so about 1/4. And uh, let's see, what are the other ones? We got cobalt, copper is taken. What about the vanadium?
The vanadium royalty is one where you've seen pretty sizable price changes in the
Yeah.
past 5 years.
Yeah, it's pretty volatile.
And actually, in some ways, I mean, if you'll indulge me for one moment,
Yeah.
I think when we look at our royalties, and it really is the beauty of the royalty model, right? When you acquire royalties over projects that have long mine lives and the potential for life of mine expansion, your exposure then is to multiple cycles. So when we acquired our vanadium royalty, the long-term price was something in the order of $6 per pound. We've seen vanadium prices go from lows of 3 or 4, if you go back, 10, 15 years, to highs of about $30 per pound. So today, the price of vanadium is somewhere in the order of $5 per pound. Cyclically, it's at a lower level, but this royalty has a mine life, a reserve-based mine life at the mine. The mine has a reserve-based mine life of 30 years. So we have lots of time to hit multiple cycles. And the run rate currently for that royalty at $5 per pound is somewhere plus or minus of $2 million.
Okay. Okay. And what about uranium?
Our uranium exposure is twofold. The first is we have exposure to Cigar Lake via a toll milling agreement. So effectively, mine and material, the Cigar Lake mine mines the material. That material is then sent to the McLean Lake mill and processed. And we have an entitlement to part of the toll milling proceeds that are generated when that the material is milled at the McLean Lake mill. Our next exposure is to a mine in Australia producing called 4 Mile. And that's an ISR operation. That operation has historically done in the order of 4 to 5 million pounds of uranium per year. Looking into the future and potentially the distant future, but hopefully not too distant, is the Patterson Corridor East, where we have an earlier stage royalty, but over a sizable deposit, and that's owned by NextGen.
Okay. And coal?
The coal royalty is one that is actually quite variable for two reasons. First, because mining operations are not entirely in our royalty area in any given year.
Yeah.
So in the first half of last year, we saw a lot of mining in our coal royalty at Kestrel, not so much in H2. In the first half of this year, we're not expecting to see huge amounts of mining at Kestrel, more so in H2. And the other thing is that there's a ratchet at Kestrel, where if prices exceed $300 per ton, Australian dollar terms, we're entitled to receive 40% of the revenue. And if you scroll down to call it $100 per ton, that's slightly less than 10%.
Okay.
So it's quite variable in terms of the entitlement, depending on where coal prices are.
Okay. But that one's going to be running out soon. And then
We're running out soon, but still with some good cash flows to come.
Yeah. And gold.
Our gold is probably the smallest amount of exposure we have to any commodity on the producing side. We have a royalty of a producing mine in Spain called EVBC. That royalty is in what I kind of think of as triple overtime, where the mine life has been extended far beyond the reserve-based mine life at $3,300 per ounce, or where we are today. We see real potential for that life of mine to be extended beyond the 4 years currently contemplated, but we'll have to see.
Cash flow for the company is coming from that now, and what do you think it'll be? No one's going to hold you to this, but what do you think, if you had to guess, it'll be at the end of 2026?
Well, I mean, ultimately, you have to pick your commodity prices, so let's just keep them flat.
Keep it flat, yeah.
And your listeners can take their own view on price levels. I think for this year, the asset has the potential to generate somewhere in the order of $15 million.
15, 1,
Yeah.
5? Okay.
And then fully ramped up. So we're expecting, well, how about this? I'll tell you the volumes.
Okay.
So this year, the asset is expected to generate somewhere at the midpoint of our guidance, somewhere around 340 tons of Cobalt Ecora. Fully ramped up, the asset is expected to generate approximately 560 over the life of the mine.
Okay.
So if you put, a $20 cobalt price on that, our stream at the fully ramped up levels would be approximately $20 million.
Okay. All right. That's good. And you said that what's your annual cash flow right now?
Well, the business generated $63 million last year, and free cash flow was around $20 million last year.
Okay. So this is significant then.
Yeah.
Okay. All right. You also have, so we got cobalt. Go into some of your producing and big copper plays.
Yeah, so that's something we're really happy to have in our portfolio, and it's something that we started accumulating 6 years ago. We saw the copper market as really compelling in the longer term. Our first royalty into copper materially was the Mantos Blancos royalty, and that's owned by Capstone Copper. That's an asset that's really hit its stride in the last couple of quarters, and with a lot of potential production upside beyond that. Currently, Capstone is evaluating the possibility to expand undergo a phase 2 expansion.
Mm-hmm.
The feasibility study expected in the second half of this year. Capstone is also evaluating the possibility of retreating waste material. So this is material that is waste historically, but could be retreated and could potentially add, based on Capstone disclosure, 25,000 tons per year, which is not insignificant when you look at Capstone guidance for this year in the order of 50 to 60,000 tons. And certainly illustrates one of the beauties of the royalty model, where good assets tend to get bigger and run longer.
Yeah.
Our latest copper addition is the Mimbula stream. This is a producing mine. The asset produced approximately 14,000 tons last year, and a brownfield expansion is underway to take production capacity to 56,000 tons per year. So those three base metals assets are really at the front edge of our growth profile, expected to drive growth in the next couple of years. Beyond that, we have a royalty at Santo Domingo, also owned by Capstone Copper. And this project is now really at the front edge of its development. Capstone is currently evaluating the possibility of bringing in a partner, very similar to what was done at Mantoverde, another copper mine by Capstone Copper in Chile. Capstone brought in Mitsubishi and Mantoverde, and they're currently looking for a similar approach as we understand it based on their disclosure. to Santo Domingo. And next, they've said that Capstone has stated that the project will be in a period of FID readiness sometimes next year.
Okay.
That's a pretty material royalty for us. If you sort of look at the latest feasibility study published by Santo Domingo, and pick your copper price. But if you run spot, that royalty has potential to generate $30 million a year for Ecora once in production. So it's a big one for us, and we're watching it very carefully.
Oh, yeah. Okay. So when do you think they could turn it on and start pouring metal?
Yeah, well, based on the feasibility study timeline, it looks to be a 2 to 3 year construction period.
Okay.
So working backwards from target final investment decision date of 26 would imply production at some point 28, 29. But it is subject ultimately to when the final investment decision is taken.
Okay. Well, depending how things go, at least as of today, copper's up like 10%. So depending on where you're at.
And, that's the one thing that we really like about the Ecora portfolio is that we have volume growth potential from assets in production, medium-term growth potential from assets that are really the front end of the development curve, and then as you move into the next decade, further growth potential from assets that are slightly behind in their development.
Yeah.
So the Ecora copper pipeline organically that we've acquired, that we own, that we don't have to deploy any further capital into, really provides a growth pipeline of copper that, from Mantos and Bula, fully ramped up, is attributable copper pound slightly less than 5 million, and the pipeline in the next decade could take Ecora to attributable copper units on an equivalent basis to 20 million pounds. So copper is really at the core of our portfolio and our growth, but we have other commodities in addition to that. We have nickel exposure, and for your viewers, nickel is from a cyclical entry point. Now would be the time to think about getting a nickel exposure. In my opinion, we have uranium exposure. Some really household names that you'll know well, like Cameco, for example.
No, never heard of them.
Okay. And longer term, Nextion's Patterson Corridor East, which is an earlier stage royalty, but has incredible prospectivity based on what's been discovered today. So one we're looking at very carefully as well.
Okay. All right. Now, we also have some rare earths on the books, probably not coming in for a while, but tell us about the rainbow rare earths.
Well, that one could come in sooner than you think so.
Oh, really?
Yeah, so this project is currently undergoing a detailed feasibility study. The company is targeting first production in 27 or 28.
Oh.
Yeah, we acquired this royalty last year.
Okay.
This project is quite interesting as far as mining projects go because it's actually not a mine. It's the material exists historically by virtue of creating a phosphate product for the fertilizer market.
Okay.
And a byproduct of that phosphate production was gypsum, phosphogypsum. Yeah. So these stacks exist on a site, and in the material are rare earth elements.
Huh.
So the company effectively, once in production, should benefit substantially from far lower mining costs. In other words, there is no mining.
Yeah.
There's no stripping costs.
Yeah.
Much lower hauling costs. And as a result, the capital intensity of that project is substantially lower. Yeah. And the ongoing operating costs are substantially lower than sort of a greenfield conventional mining operation.
Huh. Interesting. It's almost like Cerro de Pasco is doing with the tailings or something, right? It's essentially just, it's already there. They don't got to go look for it. Okay.
Precisely.
Huh. All right. Interesting. Okay. Ballpark. Okay. So the commodities that we're in: cobalt, copper, vanadium, uranium. I got a little bit of coking coal left. A tiny bit of gold. Rare earths. As far as cash flow now, what you got coming in? What percentage of your income is coming from each commodity?
Yeah.
Does that make sense?
Yeah. So, this is an interesting question. So I'll answer it slightly differently. Okay. I think it's also important, and it'll give a flavor for what Ecora is, what it was, and what it will be.
Okay.
So if you were to go back to 2020, right, I think you'd see that the business generated between $5 and $10 million from its base metals, from its uranium and specialty metals portfolio, with the balance being for met coal. This year, research analyst forecasts are somewhere around 60 million. And for the first time, more than 50% of that revenue is expected to be generated from base metals and our specialty metals uranium portfolio. And in 2 years from now, the base metals are expected to represent the majority of the portfolio revenue. Copper, actually, subject to commodity prices, which are variable, of course, but copper expected to be the number one source of income. And as you go towards the end of the decade, the vast majority base metals, but primarily copper.
Okay. Okay. What percentage right now is cobalt?
On this year, cobalt would be somewhere in the order of, so slightly less than a quarter. But that's
Okay.
also subject to commodity prices. And I think you've seen a very interesting dynamic emerge in cobalt over the course of this year, where in the context of what was of cobalt prices being at almost 50-year lows in real terms, the government of the Congo, responsible for producing 75% of the world's supply, elected to impose a cobalt export ban and has announced an intent to follow that up with cobalt export quotas. So cobalt prices have moved 60 to 80% upwards from where they were at the start of the year. And we'll have to see based on what the cobalt export quotas regime looks like to get a feel for what the price could be in the future. But at $18 per pound, cobalt price is still at a level, cyclically speaking, that is probably below sort of historical midpoint on a nominal adjusted basis.
Yeah. Yeah. Okay. So when you say a quarter, you don't mean a quarter of 1%. You mean a quarter
of the total.
Of the total. Yeah. Okay. All right. Just to clarify that. Okay. And so coking coal is going to be phasing out.
Yeah.
And when you say base metals, can you specify which metals you're talking about in the portfolio here?
Yeah, so when I say base metals in our portfolio in the next 2 years, primarily copper and cobalt.
Okay.
As we go out to the end of the decade, the nickel exposure we have is in a project called West Musgrave, owned by BHP. That also has substantial copper exposure. That asset was in construction, although BHP paused the construction in the context of more challenging nickel markets more widely.
Yeah.
And BHP has stated an intent to review the restart of that project by 2027. So exactly when BHP elects to start that restart decision will impact the contribution of nickel, as well as a royalty we have over a development stage project called Piauí in Brazil, which is nickel mine.
Okay.
So for the next couple of years, most of the base metals revenue we anticipate receiving will be generated from cobalt and copper. And as you move towards the end of the decade, and depending on the timelines for those development stage projects, we expect to see some contribution from nickel.
Okay. Okay. This is interesting because we're talking about this with in all the members, and we're like, we're looking for a cobalt bet, and you got Glencore, who does almost all of it, right? But it's only 4% of their total base. You know what I mean, as far as like what they're bringing in for money.
Yeah.
So you guys having a bigger percentage of your income coming from that, this could be a really, really interesting cobalt play. On top of that, we like copper a lot, so I think this might fit in pretty well with our portfolio.
Yeah, I think you kind of hit the nail on the head a little bit in terms of our portfolio construction.
Yeah.
What we've sought to do is build a portfolio that's really centered around copper, but also add exposures to other commodities in a diversified way, such that Ecora is the one-stop shop for critical minerals, where you're able to get exposure to the basket in a diversified way through the royalty model. In the same way that Ecora offers rare earths exposure or uranium exposure or copper exposure. And the question, why have we done that? Well, I think in some respects, what you can achieve is reduce correlation in the commodity prices through time, and ultimately reduce the expected volatility of your revenue profile into the future. So, for example, one commodity might run, the other might be in a cyclical weakness, and vice versa. And overall, you kind of have a portfolio that generates more stability through the commodity complex, which in the royalty model offers not only the de-risked way to get exposure to the underlying commodity, but also in time we shall see, but hopefully less volatility of our revenues as well.
Yeah. Kind of like an ETF and rolled into one here. All right. Insider ownership. What percentages and invested partners? What's available to retail?
Yeah. So the company has 249 million shares in issue. The company doesn't have, a warrant structure outstanding or option structure outstanding as part of substantial size. So 249 materially is really the number of shares in issuance to focus on. The company has existed for, well existed before I joined, for example. So there are no today management with or directors with sort of founders positions.
Okay.
I think we've seen some fairly substantial purchases from in the open market from the management team and directors. I think it's slightly less than 2 million shares if you go back over the course of the past 2 to 3 years. I myself have purchased in the market somewhere around 1 million shares. I certainly see an incredible opportunity with Ecora on the value side. The opportunity to acquire exposure in a royalty company for less than the estimated value of a producing asset base and receive as a result all the development stage assets as upside is, in my mind, a great entry point and offers a great margin of safety as well.
Okay. So what percentage of the company is available to retail? Like, 80%? Is it 90%?
Yeah, I mean, I think, is your question stripping out the institutional ownership? What would be the
Institutional,
amount of shares available?
owners of the who is not selling, right? And then, so what is available to everyone watching this show? Because this is all retail.
Yeah, I think that you'll find somewhere in the order of 40 to 50%
Okay.
retail. I mean, there's a reasonable flow. And it might be a bit smaller than that now that I think about it, maybe 30 to 40, but in that order anyways.
Okay. All right. Not everyone's retail, but the vast majority of who you're talking to is. Okay.
Oh, no, the other way around. So, 60. So,
Oh, okay.
so 40 to
60%.
50% being institutional insiders or something like that. And the
Okay.
balance being retail
Okay.
or
All right.
available.
Now I'm tracking. And you own about 1 million shares?
Yeah.
Of 249.
That's right.
Okay. All right. You have a vested interest in the company succeeding.
Well, I understand royalties and I understand these assets. And I mean, for what it's worth, anyways, I see substantial value in the stock with substantial price upside.
Yeah. Okay. Good deal. What do you think, the biggest risk? What's the biggest risk facing Ecora?
Yeah, it's an interesting question. If you had asked that question 2 years ago, 3 years ago, 4 years ago, or 5 years ago, I think you get a different answer. I think today, when you look at the business from a macro, let's start macro. At the macro level, I think all of us generally believe that the world is going to need a lot of electricity in the short, medium, and long term. Whether or not it's coming from or in combination of trends like digital infrastructure, AI, robotics, EVs, renewable energy, grid investment. Across the board, I think the case from a commodity perspective is quite compelling fundamentally.
Yeah.
Then beyond that, it's at the asset level. I think our portfolio from a revenue perspective into the future is much more diversified. It's more diversified in 2, 3, 4, 5 years from now than it's ever been historically. Whereas go back 5 years and is very concentrated in one royalty. And then there's an element of uncertainty around development timelines and development projects, right? I think the best way you can insulate yourself as a royalty company to the key risk facing a royalty company is position on the cost curve. And the key risk facing a royalty company is either an asset that's in production, is not generating sufficient cash flow to stay in production, or a development stage project is delayed as a result of project economics. So we've been pretty deliberate in positioning this portfolio to assets that are in the lower half of industry cost curves. As it's estimated, approximately by third-party cost curve estimates, when we look at our portfolio, something like 80% of our producing royalties or development stage royalties are located in the lowest half of the cost curve. Which basically, in other words, means once an asset is in production, it's likely to stay in production.
Yeah.
Or the development stage assets are likely to come into production because they offer the best economics, relatively speaking, within that commodity complex.
Okay. What is the biggest unanswered question? So,
Yeah.
what's the biggest unanswered question? What is the giant question mark? If that's the risk, what's the biggest unanswered question?
Part of it, I think, is what is Ecora?
Okay.
And by that, I mean, if you look at our P&L 2 years ago, you look at our P&L today, and by P&L, I mean income statement. So for the North American audience, I'll say we're London-based. So I'll say, if you look at our income statement 3 years ago, look at our income statement as expected this year, and look at it in 3 years from now, it's completely different.
Yeah.
And I think in some ways, Ecora by some is seen for what it was. Some see it for what it is. But seeing Ecora for what it is and what will be, I think, is probably one of the most misunderstood aspects of what this of the company, and that's changing very, very, very quickly.
Yeah.
And I think part of the reason it's changing is that we're starting to see and to demonstrate free cash flow and to really show the free cash flow potential that exists in this company, first from the producing asset base. And I think that as we move through the decade, as the free cash flow potential is demonstrated from development stage assets as well, that'll really highlight what the company is and what it offers the investor universe.
Okay. Yeah. That's got to be kind of tough from your point of view, I guess, is getting it out to people. You used to just be coal. Maybe there was a bunch of people that only wanted to be in coal, and now you got to rotate out and get into the electrical bet. And but I like it a lot. I think you got some potential, and I think it'll be fun. And I especially like the cobalt and the copper part of it. The nickel. I mean, it just kind of seems like you got a little mini ETF here that seems like it's got a really nice pipeline. So.
Yeah. Well, in some ways, as I said at the top, Ecora is pretty unique. I mean, there are just not that many royalty companies that offer this commodity exposure and this level of diversification, the commodity footprint, the counterparty footprint, right? And for those looking at the royalty model, certainly most of the companies are focused on precious metals.
Yeah.
So I think Ecora offers the investor universe something that's a little bit different. The royalty model, which is well understood and proven, but from a commodity perspective, the suite of critical minerals that we're looking to further diversify and to further grow.
Yeah. Yeah. Okay. Is there anything that I should have asked that I didn't? Any final thoughts?
Well, in short, I would just emphasize the point I made already, which was, to have a look at Ecora and to take a look at it with a fresh set of eyes. For those who may have looked at it before, may see it differently from what it is and what it's becoming very quickly.
Okay. Right on. I wish you the best. If viewers want to get a hold of you, how can they do so?
Yeah, the best way to do so is to reach out to an email address, which sounds generic, but is monitored very carefully.
Okay.
It's ir@ecora-resources.com.
ir@ecora-resources.com.
Correct.
Okay, good deal. Thank you very much, Mark.
Great to have
I
you.
wish you the best of luck. We will be betting on it. And thank you for tuning in. Go to stevebartonmoney.com for more and have a wonderful day.